here's some medium-term view coming your way. Uday Mukherjee caught up with Ridham Desai of Morgan Stanley. He began by asking him about what his sense was for the markets in 2017. Listen in.
Let me go through the premise. That premise is still there, so I'm not changing the forecast. The premise is that equities today are trading at almost the same multiple as local long bonds, and that doesn't happen very often. The last time it happened was in the summer of 2013 when India got knocked on the threat of the Fed taper, and then you have to go all the way back to 2008. So in the last 8 years, you basically have had two instances. Now both of them actually proved to be very good occasions to buy stocks. Naturally so, because you could argue that India has a good long-term story in terms of growth, and therefore the cash flows from equities will far exceed the duration of cash flows from bonds, which is, the 10-year bond gives you coupons for 10 years, but equity coupons will continue beyond that. So equities should be more valuable than bonds. Now, this is the argument, and therefore I think it's the price that really attracts me. It's not the certainty of growth. In fact, if anything, I think the environment remains uncertain. And what it reminds me of is that the point of high uncertainty is also equal to the point of high return. So that's where the confidence, if any, comes from, and that's where the outlook is built. That I think we're heading into a better year for equity returns because stock valuations are far more attractive than they have been in a while.
What is the source of your uncertainty, Ridham? You did use the phrase that you're not sure as sanguine as growth, but valuations seem quite tempting to you. The source of uncertainty, would you say, is local because of the headwinds that we've got buffeted with demonetization, etc., which is making the picture very murky in terms of growth? Or are your concerns largely global in nature, the way the dollar is moving, which might present challenges for emerging markets, including ours?
So Udayan, let me say at the outset that actually we are forecasting better growth next year. But then I have to also remind you, and I'm sure you remember that when we had this conversation at the end of last year, we had a similar sanguine outlook for growth. And in fact, actually things started turning around. If you look at the quarter ended September, we've had the best earnings growth since 2010. And therefore it did look like corporate earnings were turning around, and then out of the blue came this demonetization move, which arguably has delayed the growth cycle between, say, 1 or 2 quarters. I mean, we don't know really. We don't know exactly what the impact is. And that is one area of uncertainty. So even with that uncertainty, we are still expecting double-digit earnings growth next year because I think the trajectory had turned. India's growth environment was turning. And the big difference between what we are seeing now in, say, going into 2017 versus the last 2 years is that the external sector has got better. Global trade is off lows and is improving. And a quarter of India's manufacturing is exported. India does have some reliance on exports. Importantly, if you look at it just from a Nifty perspective, 45% of Nifty earnings come from outside India or are hinged to external factors. So this is actually a better environment for growth. Albeit, as I said, I mean, there is uncertainty regarding the depth and the breadth of the impact from the currency exchange, as well as you point out, from the US policy. Now, again, there, the sequencing will matter a lot. The incoming president has promised a variety of things, including corporate tax cuts, a massive boost to infrastructure spending, but also tighter trade negotiations. Now, how he sequences these things will be crucial to growth. So if he first goes for infrastructure spending in the US, coupled with tax cuts for corporate America, we'll actually see better growth. The trade negotiations may actually happen a little later in his tenure, and the negative impact of that may only be felt a little later. So that sequencing will also be important. We won't know this for the next quarter or so, and that's where the uncertainty comes from. But, to be sure, we are expecting growth to actually be better than it has been in the last 2 years.
On the subject of demonetization, Ridham, are you confident that this will be a 1 or 2 quarter hit, or Are your channel checks indicating that this is still in the realm of the unknown and there could be a few nasty surprises for the market?
So Udayan, I would reckon that channel checks are not reliable. The nature of the event is unprecedented and the channels are feeling very depressed right now. So if you just rely on channel checks, I think the feedback you will get universally is that it's going to be really bad. But these things can normalize quite quickly. The math that we've done is that we don't actually need all the 14 or 15 lakh crore back in circulation, because we reckon that a fair bit of it, maybe 30 or 40%, was stacked up in cupboards which was not actually being used as currency for transactions. So ultimately, we may only require about half to say 60% of the currency back for transactions to normalize. And I think that's a situation that we can envisage over the next few weeks. So going by that, I would imagine that activity in the economy will normalize more quickly than what channel checks are suggesting right now.
Okay, and don't forget to catch that entire conversation at 4:30 p.m. only on CNBC TV 18 today.